Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Manpreet. This is the Cut to the Chase podcast, and welcome to the stock market rollercoaster ride. It was the most volatile day in equity markets in a long time, since March 2020 in some cases. Asia, of course, closed weak with the Hang Seng closing about 1.2% lower, then India's Nifty closing about 2.7% lower. But Europe was weaker still with the Stock 600 down 3.8%. In all cases, technology leading the move lower. Now, downward momentum reached ahead in the US with the S&P 500 down as much as 4% at one point, which also meant the index crossed the 10% correction mark from its recent peak. But it did almost entirely rebound thereafter as the buy and dip buyers went bargain hunting. No surprise, we had safe havens do well on the opposite side, with gold up to about $1,840, close to key resistance around $1,855. Now, the key question here, of course, is the selling done? And look, timing precise bottoms, that's always difficult, but we think it'll help to focus on three things. First, we find it interesting that this whole sell-off, of course, started with worries about the Fed potentially tightening to cap long-term inflation expectations. But if that's the goal, it's worth noting that long-term inflation expectations did dip further. The widely watched five-year inflation expectation indicator has dipped around 2%. So if that was the goal, the Fed seems to have been successful. Second, arguably a bit of damage has been done on some of the technical charts, but many indicators now looking quite oversold, indicating we might be closer to a bottom. Though for the S&P, of course, what we think is key is how the 200-day, the break rather below the 200-day moving average is resolved by the end of the week. And finally, the perspective we mentioned before is that these sort of 10% corrections have been relatively common during past bull markets. And with the benefit of hindsight, we know they ended up being great buy on dip opportunities, even if the rebound is not very immediate. The Fed meeting, of course, now key, and that's, of course, set to end on Wednesday, US time. Now, in this discussion on risk assets, I wanted to shift gears out of equity markets towards currencies. And we think one opportunity out of this volatility sits with the Aussie dollar. This is a currency that sits at the confluence of the correlation to the global economic recovery, the correlation to Chinese demand, where policy has been easing again recently, and is correlated with risk assets. So no surprise, it was hit in yesterday's risk asset sell-off, but technically it sits in an uptrend that started around early December. So given that and how it ties into a positive view on economic and risky assets, we'd be happy to buy the dip towards 70.5 cents, closer to the bottom of the uptrend, and target about 75 cents. It's been a similar story with the Aussie dollar versus the Sing dollar as well, where we add, on dips towards about 95.8 cents, targeting about 99.5 cents. Now, inflation data today, of course, is the key, and any surprise, here could, of course, act as an upside trigger on the currency. So I'll leave you with that trade idea of the day, but if you enjoyed the podcast, of course, please don't forget to rate and like it. Thanks for listening, and we wish you a happy trading day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.